Hi, my name is Allie Quine, and I'm a portfolio specialist at Cohen & Steers covering preferred securities. Broad fixed income markets have seen a substantial wave of repricing this year, stemming from persistent inflation, interest rate volatility, and general concerns around economic growth. Year to date, through the end of July, global fixed income is down 12%. U.S. corporate and high-yield bonds are down 11.6% and 9.1% respectively. While the preferred market has performed relatively better, posting year-to-date returns of negative 8.6%, in absolute terms, it is hard to ignore the fact that this year has been a challenging environment. However, we believe this market volatility has created attractive opportunities within preferred securities that investors can take advantage of. In our view, there are three dynamics in the market right now that we believe make preferreds particularly attractive that I'll be diving deeper on in this video, focusing on higher current income levels, healthier issuer fundamentals, and preferred's historical tendency to rebound following significant drawdowns like we've seen so far this year. First, I'd highlight a few numbers related to income levels. As of the end of July, the yield on the preferred market has risen to 6% from 4.2% at the end of 2021. This has been driven largely by securities repricing in a market that's demanding higher yields as the Federal Reserve and other central banks have aggressively hiked rates. We are also seeing higher coupon levels on new preferred issuances in 2022. These coupons have ranged from 6% to upwards of 10% on new securities, depending on issuer quality and preferred structure, which is higher than what we saw in 2021 when coupons on new issuances were largely in the 4% range. As this chart shows, preferred yields are now above their 10-year historical averages, offering the potential for attractive levels of tax-efficient income with less duration and credit risk than investment-grade and high-yield bonds respectively. Second, we have conviction in the overall health of preferred issuers. Banks, which are the largest issuers of preferreds, recently finished their earnings season to generally encouraging results. They showed overall balance sheet strength and better than expected profitability. These issuers have also been subjected to significant regulatory oversight. In the U.S. specifically, recent stress testing results that were released in June of this year from the Federal Reserve found that the largest financial institutions would be able to maintain capital levels over twice the required regulatory amount in the event of severely adverse economic scenarios. This backdrop gives us confidence in the quality of bank issuers and their ability to withstand a potentially slower growth environment. The third reason we think preferreds are attractive now is based on what we find when taking a closer look at the historical return experience of the preferred market. While past performance is not indicative of future results, analysis shows that historically, preferreds have produced attractive returns in periods following a market correction. An extreme example of their post-drawdown resiliency can be seen in the months following the global financial crisis, where the 6-month return following the trough of the crisis in March 2009 was over 87%. The 12-month return was over 116 percentage points. However, as this chart shows, even when we exclude the financial crisis from our analysis, preferreds have returned on average 15 and 22% respectively in the 6 and 12-month periods following other recent corrections. These examples highlight just how much sitting out on a potential recovery can cost investors from a total return perspective. We recognize that 2022 has been a challenging year for investors, but we believe this kind of market volatility can create opportunity for preferred investors based on higher yields that preferreds are currently offering, sound overall issuer health, and historical performance trends that we've seen in the preferred market.